This is alpha content. I'm going to delete this video. But before I do, you might want to watch it all the way through and take notes because we're discussing the tricks, the secret tricks and techniques of the best stocks and crypto traders in the world in this episode. The reason why we made this video, number one, as you know, we have a private VIP signals room where I tell you what to buy, what to sell, what to long, what to short, how much leverage to use. If you want to use leverage at all, you don't have to. And when to put your stops in, what kind of stops to use. Very, very specific. And there's reasons for all of that. And it's come to my attention that even though we have dozens or sometimes hundreds of members in our private group, if you want to see the private group itself, it's bitcoin-signals.org. I know it says bitcoin-signals.org, but we cover stocks as well. For now, we're going to separate that out in the jiffy. But the people, even the people in our group, every once in a while, everyone else posts up, hey, I made 70%, I made 200%, I made 300% profit. That was a great trade. And then every once in a while, someone says, how did you guys make money? I just got liquidated. And everyone's like, so what I did was I planted a bunch of my personal friends and just normal people in the room to see what the fuck they're doing wrong. And I figured it out. So what we're going to do is we're going to cover all those things that normies, average plebs do, which you're probably doing, which is why you think leverage is dangerous. And I can tell you right now, leverage is less dangerous than just buying a coin. Buying and holding a coin or buying and trying to trade a coin without leverage is far more dangerous. Huh? Than using leverage? And I'm going to explain to you why. Using leverage is not only safer, it limits the amount of money you can lose, but the upside is times 10, times 100, sometimes times 125. I'm going to tell you why. Starting now. First of all, when I say, let's get some groundwork established. When I say long, it means we're going up. When I say short, it means we're going down. That's a no-brainer. Why would you even waste my time telling me that? Well, if that was a no-brainer and a waste of time for you to hear it, why is it that whenever I say short, nobody sells? Why is it that when I say long, nobody buys even spot? It's not that obvious, is it? When I say long, that means everything's going up. And then people ask me, what about Matic? What about Dogecoin? What about Shiba? Is it going to go? I'm telling you, didn't I just say? I just told you right now. And allow me to work out my frustrations in this video as well. I'm going to get really irritated and annoyed as I recall these comments that come up in our Telegram room. I just told you that when I say long, everything goes up together. Have you ever seen, when was the last time you saw Bitcoin go up alone and Ethereum go down? Or when was the last time you saw altcoins like BNB, Doge go one way, and then some other altcoins like, I don't know, Render and SHIB go the other way? If you don't notice these things, I mean, it's really hard to help you. Because if I have to keep telling you things that are obvious to notice, then I'm just wasting your time and everybody else's time that has an IQ over 90. Okay, so as easy as it is to make a shit ton of money trading, if you have an IQ of about 90 or even 100, if your IQ is under 110, just don't join us. Just don't join us. Even if you can make a lot of money with us, just don't, because you'll end up taking all of our time and end up posting stupid questions that distract everybody else from the signals. So that having been said, When I say long, it means everything's going to go up. So even if you don't use leverage, you might want to buy. You might want to buy more. If I say short, same thing. It means everything's going to go down together. Next. When I tell you to close, let's say the signal was long. Price went up. And then I say close. That doesn't mean short. What I've seen people doing is, oh shit, he said to close. I should short now. I didn't say short. Close just means take your money out of the market. Why would you take your money out of the market? Well, you take your money, look, you have a babysitter. Okay, no. Let's say it's your car. And you loan your car keys to a buddy of yours, but he kind of smells like alcohol. You can't really tell, but he might have drank a lot of alcohol. What do? You pull your keys out of his hands. You close the ability for him to drive your car when you're uncertain. That's what close means, uncertain. It doesn't mean certain reversal. It doesn't mean certain reverse the other way. It doesn't mean we're certainly going to go the other way now. Close just means uncertainty is high, pull your money out. So if we head along and we do a close right here, and you do a short, and then the price keeps going up, and then you get liquidated on your short, and then you blame me, it's like you're making an ass out of you and me without even assuming. Actually, you were assuming. You're assuming that close means reverse. It doesn't. Close just means high uncertainty. What do you do if you're not using leverage? When I say close, sell half. That's it. There's just high uncertainty. So you just sell half, sell a third, sell it all. Why not just sell it all? Even if it goes up higher, you can always make more money scalping than just letting the uncertainties of the market control your money. It's like the market is a den of wolves and thieves and scammers. Even SBF, altruism, turns out to be a total scammer, obviously. Anyone who is self-righteous enough to think that he can steal from the middle class and give to the lower class and make it be good because these people are lower class. They deserve more of our middle class hard-earned money. That's just arrogance. That's just God syndrome to think that someone deserves money more than the people that actually earned it. Don't do an opposite trade when I say close. Just pull your money out and watch. That's all. Okay? Now, I told you at the onset that it's safer, it is actually safer to do leverage trading than it is to just buy and trade spot coins. There's one simple, really massive reason for that. And it has to do partially with the fact that when you use leverage, you don't have to use a stop loss. But when you use coins, when you trade with coins, just a spot, without using any leverage, buying and selling, or stocks even, you have to use a stop loss. I'm missing something here. That doesn't make any sense to me. I thought stop losses were to stop loss, but you're saying that you can lose less money by not using a stop loss? It's an oxymoron, but it's not. I'll tell you why. I'll tell you how this works. If you use a stop loss, let's say you bought at $100, whatever it is. Let's just say $1 for simplicity's sake. You bought at $1 and it went up to $1.20. You're like, woohoo! I made 20% of my money. And us, since we did leverage trading, we did 10x long and it went up 20%. Times 10x, we made 200%. So if we put in $1,000, we end up with $3,000. If we put in $10,000, we end up with $30,000. Or is it this way? and you get to keep your measly 20%. To each his own. Now you think, okay, it's midnight-ish. I'm going to go to sleep, so I'm going to put a stop loss at the price that I bought in. So at $1, I'm going to put a stop loss. We're not going to do that when we trade leverage. What do you mean? Look, let's see what happens. What happens when you put in a stop loss at the price you bought? You think, okay, at worst case scenario, if it went up 20% and it dumps, I lose all my profit, but at least I get to keep my money here, right? Because I stop lossed here, and then if the price goes underneath. But that's not really what happens. Have you actually noticed? Have you actually stopped and looked at your balance and taken notes? On this trade, when I started this trade, my balance was $30,000. I wake up, my stop loss was hit at the exact price that I entered. How come my balance is like $30,000? I should still be left with $30,000. I'm $7,000 lower because what ended up happening was you bought in here, price went up to here. And then as soon as it went up to here, what we did, since we're uncertain at this point, we closed and we took our profits out. What you did was you just decided to do a stop loss because you're thinking you can still go up more. And then what a whale did was dumped all the way from here down to oof, boom. He just cleared the order board. He just cleared all the order books, bam, straight down to here. And guess what? You triggered your stop loss right here. But there's nothing underneath here. All these orders are gone. So what ends up happening is your order executes, poof, down here. It's like an episode of Wile E. Coyote and the Roadrunner, where he's like super excited and he thinks, whew, the Roadrunner pushes him off a cliff and he thinks, whew, I'm so glad that there was this branch or this nest full of eggs for me to land on. And then you notice that the Roadrunner also pulls that out from under him. He's like, ooh, poof. And then he's super happy that he landed in the nest, and then the Roadrunner just goes, doof, pulls the nest out from under him, and then he continues his fall, and then all you see is this little poof of dust at the bottom of the canyon. That's what happens when you use stop losses. Are you kidding? No, I'm not kidding. Whenever you see those big red dips, this guy, the guy that sold right here, he gets first shot. It's not like I'm gonna sell everything from here to here and then oh wait, but Jimmy had an order right here. So can you, Mr. Whale, can you wait a moment while we make sure that Jimmy gets his order to close out and sell here, market sell at this price before you continue your boof dump? No. Clears the board. There is no, it's like a Jackie Chan movie, except without all the other awnings underneath where he can land on, doof, 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 to break his fall. There's nothing left for you when you use a stop loss. So you think you can stop loss at zero loss. You're stop lossing at whatever the big fat whale that just dumped on you stops at his worst price. So, but what about if you use leverage? Now, if I use leverage and I think, I wanna end this deal. I don't care if I give my profit back to the market. If we never do that. We just never do that. But if we were to be stupid enough to do that, we still have an advantage over the people that just trade spot without using leverage, because what we do is we say, look, I have $100,000 or $10,000, whatever. I have $10,000 and I'm at $1. I went up to 20% at 10x. So now I have 200% more than the money I put on the line that I traded with. Woohoo! But I'm going to go to sleep. So even if this comes down and down and down, I don't mind losing profit as long as I don't lose my initial equity, initial trade money. If it comes down to this point, I'm going to use a stop loss. And then if there's a big red line, which there always is, doof, guess what? This whole thing gets liquidated. and you get liquidated, you lose everything. But I just told you we don't do that, do we? We don't use stop losses. So what we do is, if you're sure that you want to remove your money, you want to pull all your money out and close this deal. If it falls back down 2%, back down to, because this is where you bought in, this is when it went up, and if right here you want to pull your money out, 2%, all you have to do is do the ratio math. Really, really simple ratio math. All you have to do, you got your 200% profit. Pull it the fuck out. Take your profit, put it in your pocket, put it in the new Porsche, put it in the new Lambo or whatever. Why do you think I have so many cars? Pull it out. Then you have that 2% margin of error upon which you're willing to cancel this deal. You just do a simple little tiny money 50x long. If you're really that FOMOing for that extra little bit and maybe thinking that at 3 a.m. while you're asleep, it's actually going to pump, which it never does, if you've noticed. Then just do one tiny 50x. So take your $20,000 or $50,000 or $200,000 of profit out, and then just put back in another $1,000 at 50x leverage. $1,000 becomes $50,000 worth of buying power. And what happens if it falls to 2% to your entry price? You lost $1,000. And that $50,000 that you borrowed from Binance or DYDX just goes back to the lender. Simple. What if it falls farther than 2%? You can't get liquidated more than the amount of money you put on the line. So you're totally safe. The amount of money that, if you use a stop loss, you can lose far more money than you actually bargained on because of that big red dump that clears the order books. But with an actual high leverage long with X amount of money, you can only lose X amount of money. Let me put it to you this way. The bank, okay, the exchange. The money you borrow from the exchange, they will take that money away like that. The moment you get close to 99% loss, they'll just take that money right back. DYDX takes the money back at something like 60% loss. It's stupid. Just remember that, okay? That's a super tip. Write that down somewhere. When you're down 66%, they actually force close your trade. It's the dumbest thing in the world. So if I say 20x long, on DYDX, you're gonna wanna use something like 8x long. You're gonna wanna go under half the leverage that I tell you to use if you're using DYDX. I'm not kidding. It's just the way it is. It's just the truth. So the exchanges, if you get close to 99%, they'll close the deal and they'll take their money back and that's it. They're not going to lose a penny the way the exchange is structured. But the way the exchange is structured, if you have a stop loss, they don't care if you lose everything. They don't care if you only bargained on losing 10% with your stop loss. They don't care if you lose 70%, do they? Hell, FTX doesn't care if you lose 100% because they took that money and gave it to the poor people. Well, they're in the process of giving it to the poor people after they give it to, what's his name? The guy with the laptop, Hunter Biden. Unless you use cross. Never, never, ever, 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 never, 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 ever, 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 never, 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 ever use cross. Because every single thing I've described to you, your risk limitations by using small amounts of money and high leverage instead of 50x long covers a 2% margin of error. You knew that, right? The quick quiz, 3% margin of error. If price goes the opposite way in 3%, and what's the maximum leverage you can use? 33x. 4%, 25x. 5% the opposite way. And how much leverage can you use to make sure you don't get liquidated? a little over, wait, did I say 5%? Okay, 5%, a little over 20x, or a little under 20x. So let's say you want a margin of error of 10%, well, 10x. A margin of error of 20%. This thing can fluctuate 20% up and down, and I still don't want to worry about liquidation. Then it's 5x. If you're not seeing the pattern here, oh my God. Now, you know what? I'll explain it to you anyway, because I normally don't like to explain anything to people with less than 110 IQ, because then what they'll do is they'll keep asking dumb questions and take my time on. You know the 80-20 principle? It's more like the 99-1 principle, where 1% of the people that join our group takes 99% of my time. And so I like to try and pre-snip, pre-cull that 1% out. But I'll tell you anyway. This is how that ratio works. You have this much money that you're going to do a deal with, that you're going to do a trade with. Not on cross. Never use cross. Never, ever, ever, never, ever, ever, never, 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 ever, ever use cross. And you did 5x leverage. Well, guess what? You get 5 times more. You get 5 of these now that you use 5 times leverage. So you have this much money to play with, okay? This much money, let's say it's $500, and you put $100 on the line. What percentage of this amount of money that you borrowed is your equity? I borrowed this much, 5 clumps, and I have 1 clump. I have $1,000 and I borrowed $5,000. I have 20% of my money is 20% of the amount of money that I borrowed is my equity. Equity, okay, that makes sense. Fair enough, right? What if the 5 clumps that you borrowed, you only bought 1 coin, and that 1 coin went down 19% in value? Holy shit, that's awfully close to the amount of value of my equity. You know what the exchange does? The exchange says, he's like, he almost lost as much money with the money he borrowed from me as the equity, as the money I'm holding of his. If it falls even it fell a sliver more. Take it, close. Force closes you and just force liquidates you. Takes your equity, you're gone. You have no money left. That's how exchanges work. Now, instead of 5 clumps, you have 10 clumps. You have $1,000 and you borrowed $10,000, meaning you did it 10x long. Then $1,000, $10,000, of $10,000, $1,000 is 10%. So I gave the exchange 10% of this value to hold on to. Guess what the exchange does? The exchange looks at it and says, he used all this money, 10 times the money that we have of his. We have his money, but he borrowed 10 times more of our money. But what he bought, what he longed, the value dropped 9.999%. Holy shit. Close it. Bam. Liquidated. They take your money and they refill that gap that's left over because these 10 clumps lost value with your money, with your equity. Bam. Now they're whole. They're made whole and they take their money away. Same thing with 20x. You have 1 clump, 20 clumps. This 1 clump is literally only 5% of this 20 clumps. $20,000, $1,000. $1,000 is 5% of $20,000. If you cannot do that math, do not do anything with numbers. Work with dough, like wheat. If you get really creative, work with like rice dough. Don't use too much yeast. Allow it to rise slowly. Work with things like, I don't know, cash register. Work with French fries. Work with French fries and hot oil. If you can't do that math, that's the way for you. Ah, man. Okay, so now that I've explained that, why you don't use cross? You don't use cross because what cross does is it exposes your entire nest egg, your entire holdings, to that same phenomena of, well, I got liquidated here, This is what cross does. You have $10,000 in the account. This particular trade, you only want to put $1,000 on the line. You put $1,000 on the line, thinking, hey, I can only lose $1,000, but you have $9,000 left in the same account. You did a 10x long, price goes up 1%. Hey, you made 10%. Price goes up 10%, you doubled your money. Yay! So now I put $1,000 here, 10x long, price goes up 10%. 10% times 10x is 100%, right? So I put $1,000 in, 100% of $1,000 is another $1,000. So now I have $2,000. $9,000 left. Remember, we started with $10,000. $9,000 here, $1,000 here, and a new profit of $1,000. Woohoo, great. Cross works great. Until you decide to go to sleep. And price back falls right back down, so you lose that new $1,000 profit. And price goes the other way, 10%. If price goes down 10%, now you've lost your $1,000 that you put on the line. Price goes down another 10%. What ends up happening is, did you get liquidated? Holy shit, did I get liquidated? You're like, whew, I woke up in the morning and I wasn't liquidated. What ended up happening was, the money that you put on the line, the $1,000, is gone. But now the price fell 20%, and you only put $1,000 on the line, but looky here. There's $9,000 left. $1,000, 10x leverage, 20%. That's 200% loss. So not only did you lose your $1,000, but 200% of that. So there's another $1,000 you lost. But how's that possible? I only put $1,000 on the line. That's not how the exchange sees it. The exchange sees that $9,000 you have left and says, oh, look, we'll just take another $1,000 from your nest egg that you didn't put on the line. Thank you, pluck. So it takes this away, poof, gone. And then it comes in and takes this, pluck. And then for every 10%, it falls more. Oh, look, you have all this extra money we can pluck away. That's how the exchanges work if you use cross mode. And you cannot switch between cross mode and isolated mode during a trade. Are you getting these things? Now, in our group, when we have profit, and we almost always, like 9 trades, 11 trades in a row, we'll end up with profit. And then 1 trade will end up with a little loss. And probably one every 20 or 30 trades, we end up with a liquidation. Literally. But those liquidations are tiny because we know exactly how much we can go the opposite direction. So we use lunch money, literally like $50, or even if you're a multimillionaire, that $50, you know what that does? That just satisfies your gambling needs. That just satisfies your gambling sensibilities, addiction. That's all that's for, so that you don't use bigger money if you're compulsive. But when we're in profit, since our win ratio is so astronomically, ridiculously huge, when we're in profit, I will say stop. Now, a lot of you guys will think, okay, we should stop loss here. And then what you'll do is you'll take screen captures of that and you'll post it on social media. And the morons in social media, on Twitter, will think, Bitcoin fund managers, bitcoin-signals.org group, they just end up doing stop losses all day long. They suck. When I say stop, I mean stop profit. What's that? I know what a stop loss is, but what's a stop profit? Stop profit is the same as a stop loss, except the difference is you end up with money instead of losing money. Since you're in profit, and if I tell you, price went up 10%, okay? And I tell you, hey, you should stop now. What that means, when I say close, what does that mean? That means it's high uncertainty. It could go both directions, 50-50 chance. When I say stop, what that means is there's still a higher chance that we continue going up. That's what stop means. However, this is a really good support point to where if we break the support, we're going to go way down. So just put a stop right about here, is what that means. But we are going to keep going up. Not only that, but it means that when I say stop and it keeps going up, you can actually close at any point. You can close at any point after that stop signal. Take extra profit or just close immediately when you hear stop. Stop does not mean, or stop profit does not mean that we have high uncertainty. It just means we're starting to build risk at this price. Did you get that? Close means we have high uncertainty. Stop profit means we're building support at this price. So we can continue going in the same direction, and you need to protect your profit. Now, here again, if you do a stop, exactly the same principle as I mentioned before, belaboredly, if you do a stop profit, a market order stop profit, and suddenly there's a huge red line, zoof, same thing happens. You lose all your profit. But I only wanted 0.5% margin of error. I put my stop order line at 0.5%, so I was only going to lose $300, but I woke up in the morning and I lost $3,000. That's because of a big red line that ends up cannibalizing all the buy orders, all the support orders. First, before your trade goes through, before your stop gets executed, always remember that you're second in line. You might not even be second in line. There might be a bigger whale. Did you know that? That exchanges give bigger whales trade priority? Let's say you pulled a stop. You said at this price, at exactly $69,000 for Bitcoin, I'm going to put a stop loss in because I'm smart. And that's a meme number, and I think $69 is the way to go, or $69,000 for Bitcoin is going to be the top. Let's say you called, we did, by the way. I told you, you really need to sell at $69,000. You put a stop loss in thinking, hey, I'm going to get $69,000 worth of USDT back out of this crappy exchange. No, you're not. Because some guy who placed an order in after you placed your order, maybe days late after you put your stop in, is a mega whale. He's a VIP for that exchange. Guess what? His stop loss order goes in before yours. I'm not kidding you. Aren't you glad you watched this video? So that's why you only put the amount of money that you actually want the exchange to lose. Total. Then the exchange protects your money by using leverage. So 2%, just use a 50x. 3% margin of error, use 33x. 5%, use 20x. Really, really simple. If you have a hard time remembering that, maybe use a pencil and a piece of paper. Pencil, paper. I know. If you're smart enough not to get offended by this, thank you. But, I mean, my God, social media sucks. But, I mean, that's also how I get all my clients and how I build my nephew network. Did I tell you this? I get a lot of questions. I get this question a lot. If you're so good at trading, how come you need customers and clients? I mean, dude, Warren Buffett has clients. Warren Buffett takes clients. Daly takes clients. All the world's best traders, they all take clients. It doesn't mean they're not good traders. It means they're fantastic traders. I don't get it though. If you can make this much money trading alone, why do you even take clients? Two reasons. First reason is practical. First reason, if you have more clients, you have more leverage. You have more money that you can actually influence the markets with. So you have force. You can actually control. Whether this becomes a support or whether this becomes resistance. You're not. It's like having a huge, high-power steamship versus a tiny speedboat. Tiny speedboats gets moved by every single little wave, but huge steamships with massive engines create their own waves. and it's a lot more stable. There's just a lot more power to masses, but it doesn't matter, because for me, my algorithm, once every 30 trades, I lose money. So I don't even have to control the waves or the seas or the tides, because I know exactly which tide is going to come in, where, how high, how fast, and when. So I could trade alone. You're absolutely right. I don't need the assistance of volume. I tried that. So I did. I tried that. I turned, I don't know, I think it was like $50 or $80 or something like that into $500,000 or $800,000. And then I decided I was going mad. Literally going mad, because sitting there for a month and a half alone, not talking to anybody, you start hearing your own voices in your own heads. It's the weirdest phenomena. Anyway, that's what happens in solitary confinement, except so it's just not healthy for a human being to be working alone for months on end, 24 hours a day without sleep. So that's why I have clients and so on. So if you see anyone asking that stupid question, just slap them in the face for me. Otherwise I have to block them for being stupid and lazy, because they would have known the answer to that stupid question had they watched this video. What else there were a couple important things to cover. And this is the most important thing. So everybody in our group makes a ton of money, and then there's always one kid that says, "No, but I got liquidated," and everyone's like, "How did you get liquidated?" And they always say this. They say, "You said short, but then it went the other direction." Oh, no. Before I cover that one, I'm going to cover that one. But the real dummies, the super dummies, are like, "I woke up in the morning and you said short, so I shorted and I immediately got liquidated." Okay. Look at your telegram. Look at the timestamp of the signal. How much time was there between your waking up and that signal? 5.5 hours. It's like you're driving on the freeway, and I tell you, turn left here. And then 5.5 hours later, you turn left. And you're driving on the freeway. This is why I post up charts. So you can download the chart. You can look at the chart and then look at the chart on your computer and your cell phone and say, "Oh, look, price is about in the same place. There were no wicks, there were no big movements. Price is just still in the same range. And there haven't been any moves yet." Then you can still go in. Or if you're uncertain because it has been over, and normally I recommend anywhere from 1 minute to 3 minutes. Sometimes you get like 2 hours or 3 hours. Sometimes you get a day or two to react. You really do. But I recommend anywhere from 3 minutes to 10 minutes. And if you're not sure, just ask, is this trade still valid? What ends up happening is before I say close, that means we're still going to go in the same direction. So wait, does that mean I'm safe? You said 23x long, and you didn't say close yet, so that means we're still going up, right? Yeah. Okay, cool. So I'm going to do a 23x long now, although I got the signal 5 hours late. Is that cool? No. I don't get it. It was okay for those guys 5.5 hours ago to do a 23x long, and we're still going up. But I can't do a 23x long now, 5 hours later, even though we're still going up? That is correctamundo. Why? If you don't know the answer to this, oh my God, do I have to explain this too? This, let's just make it simple and say 20x. Let's just say I called 20x, okay? 20x long. Here. And the price is still going up, price is still going up, price is still going up. I called the 20x long because what's the reciprocal of 20 times? 5%. Because liquidation would be about 5% lower than the price you bought it. So if this is $100, liquidation is $95. If price hits $95, then you get liquidated. That's why I said 20x right here, okay? But price is still going up, going up, going up, going up. So it's $100 when all of us, most of us got in, and then some lazy ass decides to get a good night's sleep in, wakes up bright and early at 10:27 in the morning, goes for coffee, takes his dump, and then comes back at 11:40, and then decides, hey, it's still bullish. It's a 상승 시장, which means it's still a bullish trend, which there's no such thing as still a bullish trend. It's just all chop. And he decides everyone else went in 20x and price is still higher, higher, higher. I'm going to go in 20x as well. Oh my God. This is $100, okay? We did 20x because liquidation looks like $95 was going to be liquidation. Right now it's $110. Yes, it's still going up, but if you do a 20x long at $110, your liquidation line is right about $105. And the reason I called 20x at $100 is because strong supports at $95. You do a long at 110, and there's a sudden wick that goes doop, boop, doop, boop, literally just dumps $5. Doop. You get liquidated, and then it continues up. You're the only one that gets liquidated. Even though we were still bullish, even though there was no close signal, because those leverage numbers are precisely tuned for our liquidation point, for volatility. That starting to make sense now? So if you're lazy, or if you just have to sleep for whatever reason because you're not lazy, but let's say you've got an important job, you've got a really important job, you're a fireman or you're a nurse or something, a really important job, you have to have your sleep, agreed. Then at least when you wake up, compare the price now to the price when the signal was actually given. Then do your calculation. Get your little calculator out if you can't do it in your head, which you should be able to do this in your head. It's simple multiplications. Get your calculator, or just create a scale. Just print out an Excel spreadsheet or Google spreadsheet that has all these ratios. And say, price was $72 and BFM said 30x long. So 3% less than $72 is about $2.20 lower. So $72, right at $69.8. $69.8 is liquidation. But right now, it's not $72 anymore. Right now, it's $78. So 78 minus $68 is $10. $10 is my margin of error. What's the ratio between $10 and $78, which is right now? That's about 13%. So if I have a 13% margin of error, and everybody else who started this trade had a 5% margin of error, I have a 13% margin of error. I can't use 20x, can I? Bingo. That's how you do that math. If that, I'm not kidding you, I'm not kidding, I literally spelled this out 3rd grade level. If you can't follow me this far, if this much doesn't make sense to you, crisp cut, spicy Cajun, thin cut, but never fat wedge. Okay, what else do I need? Okay. This is the most important thing, actually. Oh man, it's so stressful talking about this because it makes me pull up all the moments of me dealing with ignorance and stupidity and inability to calculate simple math. Just so frustrating. It's third grade math, guys. No, it's like first grade math. This is the most important thing. I say short, and the guys, the members, all make money on the short. And some other guy says, but how is that possible? BFM was wrong. It went the other direction. It went long, so I took a stop loss on my short, and then I went long, and then it finally went the direction Bitcoin fund manager said. Hours after he said, even though he said that you should only react within minutes, it took hours later to go down. It kept going up for hours. Remember, the reason why you should do a trade within 2 to 3 to sometimes 10, 20 minutes is that even if price doesn't give you profit, price doesn't move in the direction that gives you profit, price doesn't give you profit for hours, is because at that moment, compared to liquidation line, that is how we that is how we determine leverage. That is how we determine leverage. So the moment price changes a little bit, your leverage changes. And if you can't do that simple math, I mean, pizza dough is fine too. Thin crust is good. Thick crust, the stuff with the mozzarella actually baked into the crust, that's fine too. Let me show you what actually happens with a chart. Okay, let's use this chart. Okay. This is when I tell you to short, right here. Why? Because we got a head and shoulders. 1, 2, 3, perfect head and shoulders. I tell you to short here. But wait, you told me to short and it went the opposite direction. Yes, it almost always does. Look, here, I got another one. I got another one for you right here. Let me move this out of the way. Look, one touch, one triangle, perfect triangle, 2 perfect triangles, 3 perfect triangles. What ended up happening? We shorted here. What ended up happening? It went the other direction. Before you get profit, it went the opposite direction. Follow the blue line. Before you get profit, it always goes the opposite direction before you get profit. Always. Literally. So what we do here is I tell you to do a 10, 20, 30, 40x long here. Why? Because look, it always goes the opposite direction. Almost always goes the opposite direction first before we make profit. But how much can it go the opposite direction is determined by the size of the last head. The size of the last head from here to here is, oh shit, it's gone. Hold on, let me click it. It'll come back if we click it. There it is. 1.34%. So that means that we can go the opposite direction before we make profit by 1.34%. Maximum. We can't go the opposite direction higher than this right shoulder. If we do, it invalidates this entire head and shoulders thing. It invalidates this entire thing. So then we lose money, but we never lose money because we only call legit head and shoulders where we don't challenge the right head. Anyway, if we have a 1.3% margin of error within which we can go the opposite direction before we make profit, then how much leverage can you use? It's over 1%, right? So you can't use 100x. It's under 2%. So you can use over 50x. Here you could have used 70x 60x, 70x easily, comfortably. But hey, it only actually went up by like 0.6%. So you could have used 125x leverage here. You could have done 125x leverage long here, not get liquidated. You'd lose about paper loss, about 70% of your money before you make money, before you get profit. Same here. If you did 100x long, you'd lose about 50 or 60% of your paper value, paper loss, before you get profit. So what we do, we put about 30% of our money here, and then we sprinkle orders upwards at an increasing scale, so that all our orders get taken, so that all our orders get executed, and we get a huge, massive, fat short piling up, stacking up here before you get profit. Then how come you don't wait until the bounce? How come you don't wait to short until the top of the bounce? Well, because sometimes that's not what happens. And we only call big profit signals. So opportunity cost is too high. That would be the short answer, but most people didn't understand what I just said, so here's the long answer. 70% of the time, price, when we short or when we long, price goes the opposite direction before you get profit. 70, 80% of the time. But 20 to 30% of the time, the moment you get a head and shoulders, or the moment you get a bearish triangle, or the moment you get a cipher, or the moment you get a Gartley, or a shark, or a snake, or anything, confirmation, 20% of the time it just goes straight down. And our signals are designed to give you maximum profit. So it would suck, even 20, 30% of the time, it would suck to lose out, to miss out on a 3, 4, 500% trade, wouldn't it? So we go in immediately upon confirmation, and then we stack bigger orders in, because most of the time price goes the opposite direction before. And I'm overemphasizing this because I hate seeing newbies that have no grasp of the obvious, where I draw a head and shoulders, and then the chart clearly shows you that we're going in the opposite direction before we drop, and they're still like, but you were wrong, you said short and it went up. And then they post that on my social media, and then all our competitors and all our haters go, ha ha, I told you not to listen to that scammer Bitcoin fund manager, he's always wrong. And then I have to block more people, and it's just a waste of my time, guys. I'd rather be looking at the charts, making you rich, than activating my bots to find everybody that's a hater, a scammer, a competitor, and just blocking them all. It's just a waste of my money managing social media. So now you know. How to set up orders. Okay. So if I tell you 50x, that means all you have to do is go in now and put support orders in right at around 2% the opposite direction. That easy. If I tell you 20x, that means long or short, whatever it is, do it now with about 30% of your money, and then sprinkle the rest all the way up to about 3% away from current price. So you kind of got to know what current price is, which is why I post the chart, which is how you do the trade. If you wake up 8 hours later, pull up your own chart. Literally pull up your own chart. You should probably use the same charts I'm using so that it's easier for you to visually recognize. Just tune it to the same minute candles. I'll use 5-minute, 10-minute, 30-minute candles. Just tune it to the same minute candles. Download Tab Trader, TabTrader, Tab Trader. It's the best app, and it's free in the world. It's better than TradingView, far better than TradingView. and compare. And if you're still not sure, just ask in Telegram, in the Telegram room. Now, you're totally, fully, completely equipped. You have absolutely no reason to lose money. Now you can join bitcoin-signals.org and make shit tons of money and become a whale yourself. Because you're not making any of the stupid, nonsensical mistakes that the stupid people make. Basically, you're ready to get rich. So join us. We've got a big move coming in right now. Yep. Big move coming in right now. So I'd recommend you join us now. Oh, by the way, every week or two, the price goes up. But if you buy in now, your price gets locked in until you create a hiatus or you create a gap in your membership. So if you join in now and then you miss out for 2 weeks in a row, then you have to get in at the higher price. But if you join in now and you only miss 1 week or whatever for, let's say you're going on vacation for a week or so, you can come back at the same old price that you joined. So since prices are constantly going up, you kind of want to join and become a locked-in low-price member at bitcoin-signals.org now. Get rich.